What's going on, guys? Hamilton here with the Trading Initiative with this week's Markets in Focus. Today is July 28th. It's currently 7:10 in the morning Eastern Standard Time. I do have to make this video a little earlier than usual because I'm having surgery today, so I will not be able to make it later. Without further ado, let's go through this week's action ending July 28th. As you can see here, we love to start with this intermarket analysis tab within Koyfin, and realistically we're just looking at different assets that are meaningful and how they've responded week over week, over the last quarter, over the last 6 months, etc. And really the theme here is continuing from last week. Value is beginning to outperform growth on a week over week basis. We can look at this 1 week return here and look at crude oil up 4.86%, copper up 1.99. Commodities have had a very good week or two, depending on which commodities you're looking at, but kind of reigniting that inflation argument, right? If commodities are rising, does that potentially pop, inflation back up? We can see that the commodity index is up 1.96 as well. But there's another theme starting to emerge here: emerging markets. Emerging markets have done reasonably well this year. A lot of emerging markets have actually outperformed the U.S. domestic market, which we're going to look at in 1 second. And so there could be an opportunity here for you to grab some exposure in emerging markets on a breakout basis, right? Not everything is going to be breaking out. Some stuff is already up, but we clearly do have some areas of the market that are breaking out in the emerging market space. And I'm going to give you a hint. It's not China, at least not yet. The Qs as of this morning are down week over week, another 0.04% down. Large cap growth. Meta reported this week. They blew expectations out of the water. They popped up huge, but other names really were lagging. And I think that's really a huge theme that's emerging in the market. Every down day in tech just seems to be, and growth in general, just seems to be a little bit more drastic than when value starts to pull back. I'm talking energy, industrials, healthcare, financials. The market might pull back on an intraday basis, but value is just not pulling back as much as growth right now. And we're actually seeing value start to outperform. So we'll have some red days in the Qs, and SPY will stay green because of those value sectors still propping up. That is starting to become a theme week over week. We're seeing it inside of TTI. We're seeing it on an intraday basis. Highly suggest you guys, at the very minimum, check it out. See for yourself if that is confirmed or not. Now, the dollar right now is up. We're going to talk about that in a second, but that is impacting Bitcoin. Bitcoin was unable to break that 31,000 level. We're going to look at it in a little bit here, but that has had a detrimental impact to some of the Bitcoin mining positions, some of the ETF stuff coming out. The demand just isn't there. Is this all correlated? You have to ask yourself, are these risk assets moving in tandem? And we reasonably expect, yeah, we think they are. So as of right now, the theme continues from last week's Market in Focus that value is just outperforming growth on a week over week basis. And therefore we expect that the next 8 to 12 weeks, there's going to be better rewards found in those value sectors and maybe less so in those growth sectors. We're going to look at U.S. sector and industry from a macro standpoint and then pull it up individually really quick here. Let's look over the last month and just kind of get a general idea of how things are moving in terms of that value growth narrative. Oil services, up 20% over the last month. Regional banks, there's still people sitting here saying that regional banks are going to capitulate again. We don't see it. We have positions long. They are up relatively large, up and over 100% on multiple positions. And regional banks are up 17.84% on the month. Another up week, 2.26. This is a theme. Oil and gas exploration and production. That's your XOP ETF. You got clean energy that's finally up but down on the week. You have the energy sector, which is leading here right now over the last month, up 8.44%. Anyway, you can kind of get a general idea here. Guys, value is starting to outperform growth. I'm going to continue to say this until it's not true, but we're seeing it week over week. We're starting to see it month over month. And listen, guys, one day isn't a trend. Right? One day is not going to dictate a primary trend. A week, there might be something there at the very minimum, right? Maybe, hey, this is out of the ordinary. We should be focused on this. A few weeks, there's probably something starting there. And then once you start to get on the monthly basis, there is something there. And it's up to you to be able to identify that and actually take those trades. Okay, so right now we're at that cusp where a few weeks in a row, we're starting to see these trends start to form, value over growth, and we're seeing it play out time and time again. So really quick, we're going to run through U.S. sectors here and just give you a quick overview here. We're going to stick to the quarter to date charts. This is going to give us about a month's worth of data. And this is realistically what I want you to look at here because it really only has been about 2 to 3 weeks, maybe 4 weeks where value has started to outperform growth. And I want to prove it to you, right? If we go back quarter to date, data starts June 30th. Energy has outperformed every other sector in the market. Financials up Second on the market, communications, thanks to Meta, right? Meta and Google absolutely blowing expectations out of the water in terms of earnings. But everything else has really sputtered underneath SPY. And I'll be honest with you, as traders, it's a lot easier to be trading sectors of the market that are performing better than the benchmark. Trust me on that one. So if you're trying to go long, maybe stick towards those sectors that are outperforming SPY. Otherwise, you could be buying some underappreciated assets. The breakouts might not be as sustainable, etc. Everything underneath on a quarterly basis here, including industrials, which is up at all-time highs. We do have some exposure. It's just not performing as well as energy and financials. You can see down here, though, tech, very much underperforming, and consumer discretionary hovering on potentially negative territory on the quarter. This is why we're starting to see that rotation out of growth and into value. We're going to pull up industries really quick. You get a better understanding where the real strength is. KRE, regional banks, up 17.63% quarter to date. Oil services up 15.65. Oil and gas exploration and production up 7.23. These are the areas of the market where you should be looking to trade if you are a swing trader looking 30, 60, 90, 120 days out. This is where the strength is emerging in the market right now. You don't have to like it. You don't have to agree with it, but this is what the data is telling us. So if you're not willing to trade those areas, you're going to have a harder time participating over the next 8 to 12 weeks. That's what we're expecting. And that's why, over the last few weeks, we've been putting out videos where we went long JP Morgan, we went long some regional banks, we're starting to go long some energy-related names, and we're going to go over those in 1 second here. Last thing I want to point out, just because I talked about emerging markets, are the countries, right? A lot of people are talking about China right now. There's Chinese stimulus going around, and everybody wants to buy China. Guys, that same narrative was in the market back in October and November of 2022, so almost a year ago. And as you can see, going back year to date, starting in January, China has done nothing. It's actually down on the year, negative 0.29. There's going to be a time to own China, and we just don't think it's yet. I'm going to go ahead and add Argentina onto this list as well. I want you to focus on the countries, the emerging markets outside of China that are doing well. Greece, Argentina, and these are areas where if you're involved with international economic situations whatsoever, Greece and Argentina are not supposed to be the winners here, and yet they are. And I think that's what differentiates technical trading from other styles of trading is we solely focus on price. If price is moving up, we don't necessarily care about the narrative behind it. If we can identify the trend and we can trade it, we want to. The narrative guys are struggling to understand why Argentina and Greece, two of the weakest economic countries in their sphere of influence, are up the most year to date. I don't have the answer either. I was just in Argentina last year. The situation is pretty dire. Inflation is out of friggin' control. But here we are up 34.88%. Greece is up 47.77%. And China is down on the year. So we're going to look at that on an absolute basis with TradingView in a second. But once again, is it time to buy Chinese stocks? I really don't think so. I think people that are buying them here off of this stimulus narrative, they're going to have a hard time holding these. And they're going to get chopped up. Maybe it'll work, but it hasn't worked yet. So let's wait, okay? So let's go through TradingView here. And let's start with the most important chart of the week. Last week was the Dow Jones, which has continued its breakout. We're actually only about 5 to 6% away from all-time highs in the Dow Jones, which is insane. But this week's most important chart is the DXY, the dollar index here. We broke below 101, right? We were expecting that this would open the floodgates for risk into equities, and it did. 2 weeks ago, we saw huge moves up in the Qs. We saw huge moves up, in SPY. The Dow Jones used it to finally get up and over that 34,500 level. But lo and behold, a few sessions later, we found some sort of floor over 2 or 3 sessions, and then we bounced back up towards a pseudo support, now turned resistance. Some news came out yesterday about Japanese yields. The yield curve control is going to be changing, and that caused the market to sell off almost 1%, which it still hasn't. It's just insane to me. I think this is one of the longest runs in the last 30 years where the SPY has not sold off at least 1%. But here we are, classic TA. We have a support level. It breaks down. Doesn't matter what for. It comes up, retests that support level as resistance. What happens now? The correlation between equities, risk on in particular, and the dollar right now is inverse. It's been that way for 2.5 years now. When the dollar peaked in September, the indexes, the Qs and SPY peaked in early October, or they bottomed, in early October. As the dollar came down, the indexes came up. So as the dollar starts to break down again, indexes popped up. What happens if the dollar starts to pop up? You have to assume that it's going to be a headwind to stocks. It's going to be very hard, but I'm not saying that that's going to happen. We're still trading under the 200-day moving average. Therefore, we are inherently bearish. We are inherently bearish. We are underneath the 50 RSI. We are inherently bearish. And once again, we are testing a previous support turned to resistance. Do we break down here? Does this hold as a resistance area? Classical TA would say probably yes. The fundamental and narrative guys would say absolutely not. We're going to see who ends up winning. But this pop up and over this 101 area yesterday, these last two candles, because the new one opened up this morning, was the reason why you saw the market sell off as aggressively as it did, right? Risk was shifting out of the markets and into dollars. But now we're starting to see it sputter. I have no idea what's going to happen for the rest of the day, but I would be very, very aware of what's going on with the DXY chart over the next few weeks to see if we pop up and over this 101, 102 area and start tranching our way up to 103.78, 104 area. We're going to start to get in some trouble with equities if it gets up there. It's just going to be harder for these breakouts to sustain themselves, the rallies to sustain themselves, etc. We have one more chart that I think is incredibly important. Dixie is important, obviously, but bonds as well. We're not trading bonds inside of TTI right now, but if bonds lose this level, this TLT bond here, this $99 area, we are threatening some new lows on a historic basis going back to like 2011. Obviously, we capitulated down in 2022 down here pretty low, but if we break this 99 level that we've been able to hold over the last basically year almost, I think that's going to signal some rough times ahead in the market. I'm not going to predict what's going to happen here. We're not even going to trade bonds to the short side right now. I don't know if it's worth it, but we're still trading underneath the 200-day moving average. RSI is very much range bound underneath the 50 here, and we are supposedly, we're starting to break down from that 99 support level that's held 1, 2, 3, 4, 5, 6 times. This is classic TA. The more times the level is tested, the weaker it becomes. Bonds breaking down is just not a great thing. It does open up some opportunity though. So hopefully that opens your guys' eyes. Maybe you do want a short TLT. The setup is there, technically speaking. Let's look at a few charts. Wrap this session up. IWM is another area of the market we want to continue to watch. It has made significant progress over the last few weeks, and we are now threatening a quarter-over-quarter breakout. We're looking for a break above this 195 and a potential rally to the upside. This would signal risk on more so than it already has in smalls and mid caps, and that's what we're expecting is going to happen. We would love this, quote-unquote triple top to resolve to the upside, trends up. Everything is kind of telling us that trends are up and this thing is going to break. We have RSI oscillating above the 50. This looks good. Just going to kind of have to buckle up for this interim resistance area that we're going to be testing, or we are testing right now. We're building this consolidation fractal up near 195. But if we break this, we are definitely going to be looking at adding more exposure into smalls and mids. We already are long smalls and mids through regional banks, and we do believe small cap smalls and mids are going to be the next attack vector over the 8 to 12 weeks, assuming IWM breaks up and out. We're going to look at the Dow Jones really quick. I mentioned that this was the most important chart last week, and look what happened. I mean, other than yesterday, which was caused by the Japanese yield news, we just talked about that, the dollar popping up. Look at that rally. That is an incredible breakout. Trapped underneath the 34,500 area for who knows how long, all right? More than a year. Absolute awesome last few sessions up until yesterday, but totally expect this thing to continue to rally until it doesn't. I think yesterday's drawdown is going to mostly get bought back up. I have no idea, though. We are pre-market. And we are slight up, so we'll see what's going on. We're less than 5% away from all-time highs right here. Crude oil, we're going to look at that really quick because this is important. This is kind of the crux of our energy longs right now. North of the 200-day moving average, we want to be long energy stocks as they're breaking out, and they are right now. Oil is flirting with the $80 area, right? This is beginning to turn itself into an uptrend here. Like I said earlier, does this reignite the inflation argument? Possibly, but above the 200-day moving average, everybody should at the very minimum be interested in oil. You don't have to be trading it. You don't have to be trading energy if you don't want to, but this is a problem for the inflation narrative, and it does give opportunity for energy stocks to really sustain their rally. We're going to look at gold because I think this is an important chart as well. Very long, huge base being built out. Not sure if this is the time to be long in gold. Actually, we're not long gold, and I don't know when we're going to be long gold, but above $2,000 from a long-term time frame, you got to be interested in potentially long in gold. You know, there's an opportunity here. It's a really long base going back 3 years now. You know, if this wasn't a gold chart, people would be looking at this and going, I want this, I just don't know at what price. But because it's gold, it's stigmatized. I think above 2,000, it merits some more attention. 3 charts, and then we're going to call this a session. NUE, this is a steel stock. Commodities are starting to break out again. Materials sector in particular is breaking out again. The materials sector, I think, is 5 or 6% away from all-time highs, and it is breaking out right now. This is Nucor NUE, really nice ascending triangle formation here going back to January of 2022. We have a price target of north of $200 off of a 175 breakout. We love this setup. North of the 200-day moving average. It's a little bit slower on the ADR, but RSI is confirming bullish momentum, and obviously at all-time highs, we don't have to worry about any sort of resistance coming in after the breakout here. So awesome opportunity here, and you're going to see 2 other charts that look relatively the same. Fractals are found across all time frames, across all assets here. Southern Copper Corporation, another materials related play. Copper is showing relative strength right now and starting to break out as well. So we're starting to see the equities companies that use copper, you know, as their underlying asset, at least in terms of price movement, start to break out as well. So SCCO, you got this really nice horizontal fractal. It's not an ascending triangle, but it's a horizontal fractal here, still giving us an awesome risk on level above 80, 175, $82. Excuse me, targeting that north of 100, that 105 area. RSI is above the 200 day, or excuse me, RSI is above the 50. A little bit slower on the ADR, but most of these material related names are. This is an all-time high SCCO. So there you go. There's one more. And the last one here, which is an oil related play. Once again, it's a commodity based play. All 3 of these, right? Steel, copper, now oil, TRGP. Almost the same setup as NUE. It's an ascending triangle going back to 2022. We like the break above 80. We're already long. So we'd like to see the 80 level hold as support with a potential pop up towards 95. You'll notice though, all of these fractals that I just went over are longer term, right? At least 1 year, potentially 2 or 3 years in terms of SCCO. These are all materials or commodities related plays. You can start to see what I'm talking about when I'm saying value is starting to outperform growth. These are awesome looking charts for a swing trader that wants time and not having to manage their positions intraday. All right, guys, I appreciate you. If you like this type of content, please like and subscribe. Leave comments below the video, and I'll catch you in the next one.